Hey guys, John Paulamy here, Actionable Intelligence. We're going to continue the interview series today with a guest, Steve Farrington. He's known on Substack as the Unemployed Value Degen. And so we're going to have a degenerate, I guess, is
Yeah.
short for that. But so we're going to have some conversation about his background, how he got into writing, and what he's writing about. So welcome to the show, Steve Farrington.
Hey, thanks for having me on. I really appreciate this. I got introduced to you. I was a guest on Ben Kelleran's podcast. So I think I was his fifth guest. So it was really a surprise to me because I just started writing on Substack and people started reaching out. It's a fantastic community, and I'm really grateful for any help to get my work out there. So I really appreciate this. Um, I kind of um, uh, this was kind of a surprise career change. Um, I was a finance professor at a university nearby. I met my wife in grad school, and she was in a PhD program. I was just going for a master's degree, but I said, "Oh, geez, if I'm going to get this woman to marry me, I have to stick around for a PhD program." So I got accepted into the PhD program and got her to marry me, and we both started teaching at a local university. And they hired a new president that, at her last university, increased diversity from 16% to 25%. And the first thing that happens is me and the guy in the office next to me, a couple of white guys, don't get their contracts renewed. Now, I don't know that that's what caused it, but I just got a piece of paper saying goodbye. They never said, "Oh, we would like you to take a year improving this metric," or anything like that. It was just contract not renewed. Don't let the door hit your ass on the way out. And uh, so, but I have to remember, gratitude is so important, both, for your own mental health and also just as a way to live and as a virtue. And they paid my mortgage for 5 years, and we had two kids on their health insurance. So it's still a good college, but I suspect that the diversity Gestapo is messing with things there. Um, I was teaching finance to undergraduates, and I thought I would find a job doing research in finance, but I had been once upon a time before grad school a financial advisor at Merrill Lynch, and but it's after the Bank of America acquisition, so it's not the real Merrill Lynch. Um, I had forgotten that when you work in finance, they have so, total. You have to have all of your investments with them. They have to see what you're doing at all the time. And when I was at Merrill Lynch, they didn't even approve me for options. So like I can get my license. I didn't have my license to advise on options, but clearly I must have known something if they had hired me to be a financial advisor. They don't even let me control my own finances. So I was in the area looking for a finance job. I get through the interview process and they say, "Oh yeah, by the way, we have to have all your trading accounts here." And I said, shnikes. That's not going to work for me. So I just on a lark, I started writing a couple Substack articles, and my third article gets retweeted by Tommy Deepwater on Twitter, and 15,000 people see that retweet. And I said, "Wow, this is really amazing." I wrote about Transocean, and it's just been growing from there, and it's a fantastic community. Everybody's really nice. Um, and it's so humbling because when I was a kid growing up, when phones were attached to walls, I had to ask my parents if we could call, my cousins within the state. It was long distance. You have to call after 6 p.m. Now I'll write something, and the next day, it'll be read by 12 people in Singapore and one person in Kazakhstan, and I've got a subscriber in Saudi Arabia and in Turkey. It's just so humbling and mind-boggling that I can write something and it's read all over the world by like 30 people in Australia. It's as far as away as my imagination can even get. So it's just a very humbling process, and it's really grateful to be a part of it.
No, you're exactly right. I mean, this genre, this Substack, the whole FinTwit community, what I have found, I kind of go back to what Munger said. I'm just a regular person, guy. I don't have a finance degree. I haven't a technical degree. I was on tools and then moved into management. So, but I think that if you have, this is the ultimate meritocracy, because if you have good insights, if you're a good writer, if you are coherent in your thoughts, if you're consistent, then you can be rewarded. And what you said was something that you mentioned that I really want to emphasize. This whole community, I have not met one person. You would think, well, I'm not going to talk with other people. I'm not going to share ideas. I'm not going to be out there because I'm, trying to protect my rice bowl. It's not like that at all. People bounce ideas off each other. People share ideas. People host each other on, podcasts. And so it's actually, I find it tremendous. It's just been excellent in this Substack platform. I encourage anybody that's out there that's aspiring to this, the days of WordPress, just trash that, get rid of your hoster, just get on like Substack, because just the internal tools, how it promotes, it almost kind of self-promotes yourself. So as long as you're a consistent writer and you're doing good things, and like I said, this community is really, really good. It's kind of like Munger said, take the best ideas from others. No one's smart enough to come up with everything themselves. I'm just paraphrasing. So, and people are very generous, and people are very, quite frankly, pretty cool. So it's like you said, the technology now of being able to basically it cost is zero to get your ideas out there to a worldwide audience, just opens up tremendous opportunity. And it's been a really tremendous experience for me. It's a slog, I think, at first, but I think if people stick with it and you're adding value, you're going to do well. That's like you said, you had like your third article took off, and Tommy Deepwater is one of my heroes in offshore.
Yeah.
I love that guy. So that's terrific. So I kind of wanted to, with that introduction, sounds good. One question I did have for you while I got you, because you mentioned you were kind of working for the Blob for a while. It's exactly right, I think. Can you just a few, if you as much as you feel comfortable? That's what that whole business is about, right? It's like getting assets under management and creaming fees. We always heard the old adages about driving by the yacht base and where are the customers' boats, you know what I mean? So, is that really, that's really how it is, right, at these places?
So a lot of the people I worked with are fantastic people, but financial advising is fundamentally a sales job, which means it's going to attract people that's all they can do. This is especially dealing with the smaller account sizes. You're dealing with the same sort of people that might work for Blue Cross Blue Shield selling health insurance. Now, these sorts of jobs, selling health insurance or selling used cars, usually rank pretty low on trust surveys. And one of the reasons for that is if you take something like restaurants, as a consumer, you go out to eat often enough, you get good at picking restaurants. But how many cars do you buy in your life? And how many annuities do you buy in your life? And how many life insurance policies do you buy in your life? The consumer is very inexperienced in this area, which means the chance that they're going to pick a bad restaurant and have a bad experience is pretty high. So just because the consumer is not buying annuities every month, the risk of a bad experience is very high, and the commissions are high. And Charlie Munger gave this talk to, I think it was, I forget which law school, but he was giving a talk to the graduating class on all the psychological biases. It's like an hour and a half talk on 40 different psychological biases. And one of them is the more you try and convince other people of stuff, the more you believe it yourself. And you see this, I had a guy knock on the door, try to sell me a water desalinator for my house. And the guy had been doing this for 8 years, and he really thought I was the biggest scumbag on the face of the earth because I would subject my wife and kids to hard water in Florida. Because when you sell something, you believe in it so much. So you have an industry where the people, they sell it and they believe in it. They think everybody has to have these products. It's not that they're, laughing themselves to sleep at night thinking about how much money they made. They become true believers. Sales jobs, attract people that's all they can do. And the customer is kind of inexperienced with it. That being said, there are a lot of situations in that world where you can really do some value added. You work with young people, you teach them about how to save, you teach them about compound interest. There's a lot of compliance so that, people are not getting the Cadillac of products. People are getting, they're getting balanced mutual funds, which for 20 years were fantastic. Now that we might be in a rising interest rate environment, the bond portion of that might underperformed pretty significantly, but it's you're kind of scooping everybody the same vanilla ice cream, the same BlackRock Global Allocation Mutual Fund, which I had I did a lot of projects with my students in the university for their personal finances, and I asked them, what do your parents do? I've had students whose parents put 100% in a savings account and just let inflation destroy them. So if you're, a financial advisor making all these commissions and you put somebody in a balanced mutual fund and you keep your 1% that's split with the mutual fund for the C shares of mutual funds, they're going to beat the heck out of a savings account. And there are still people out there that do that. So I did work with a lot of, very decent, very good people. And I think once you get deep into finance, it's really easy to forget how little people know and how much they rely on the division of knowledge and the division of labor. I had written a paper. One of my very few peer-reviewed publications was based on a survey and just asking people, what do you think does better in the long run, stocks or bonds? And like half the country gets this stuff wrong. They don't know anything. There's a total lack of knowledge out there. So there is room for mutual benefit. There is room for value added. It's so heavily regulated, you don't really get a lot of a personal touch in the matter. You're really giving a standardized product. And so that was frustrating. But I don't look at it as predatory as I think some people do, because it's just like whether you're an life insurance salesman or used car salesman or an annuity salesman, the customer is inexperienced, and when that happens, you're just gonna go to a bad restaurant and have a bad meal. It's not the right thing for you, and the only way to really overcome that is by reputation, right? If you're in a town you don't know of, you go eat at the diner in the Greasy Spoon, or just go to McDonald's because you're going to get a standardized product. Well, that's what these big brokerage houses do, whether it's Charles Schwab or Merrill Lynch. They're the McDonald's to say, no matter what city you're in, no matter what town, you're going to get this extremely standardized product at this extremely standardized price. It's not going to be the best meal you ever had in your life, but you're not going to have a bad experience at a Greasy Spoon and get food poisoning. And that's the market niche they fill. It wasn't for me, but there's some people in that world doing some good work.
So one more question in this area. So one of the things that I have written about just in general, and I'm curious because you're a finance professor and I'm sure you're familiar with this, and I think it's an opportunity also. Passive investment versus active investment management. What I have found when the research is shown, and the research that I've read, is for the average person at least, this is what's so attractive about being a passive investor, because active investing management by the average person, the research that I've read and the stats that I've read show that they consistently underperform, just like buying a Vanguard S&P fund. And I think that's a tremendous opportunity. I mean, I was talking, for example, even in my subscription base, or people that it's mostly young men. I mean, I'm sure there's a few women that listen to me, but most of these people, my demographics are young men, 21 to late 30s, that want to manage their own, are trying to find that, stock, that next stock or whatever. But I think there's this idea that, well, I'm good at whatever my particular vocation is in life, and that bias. And then kind of like, I've met so many like doctors and lawyers, people that are really good at their craft, and then they are horrible investors, or just average people that the same story, they get into, I've got couple $2,500 in an account, and I got into options, or I started getting into technical analysis. I have initial success. This is what happened to me when I was first starting out. Did really good, did not realize that it was luck or the particular time frame of the market that may have been in a certain upcycle for whatever reason. Because I have people that, I talked about bonds the other day, you mentioned, people don't even understand the concept of, and I don't say this is be disparaging, but like when rates go up, why bond prices go down? When rates come down, why bond prices have a tendency to go up? They don't understand these concepts. So it kind of limits your ability to, do certain things. And so I think that's an opportunity. I'm kind of fascinated, like Meb Faber wrote a good article about the world portfolio concept, and just because, you know, I don't think you want to have home country bias and just say, you know, if we're in an overvalued market here, you could have a decade or more of flat to down returns. That's what the GMO forward um, projections look at, because obviously if you buy overvalued markets, your forward returns historically are not very good. So can you speak a little bit? I know this is getting a little bit more technical, but this is what I actually like to talk about, but we'll get into, you know, other stuff here in a minute. But just a little bit about active, passive, why people underperform, what's the research shows, and how can people improve themselves?
Well, one of the problems in finance is access to data and access to data on individual accounts. Almost all the academic research in this area comes from one data set. There was a college professor who was sitting down at dinner. For some reason, he got an introduction. He was sitting down with Charles Schwab, and he was complaining about, hey, we don't have any data. And Charles Schwab said, oh, okay, I'll give you my data. And it's from, I believe, the mid-90s to early 2000s. So almost everything we know about consumer behavior, it was from this one data set from Charles Schwab accounts, and they were small accounts. And if somebody only has $5,000 in a brokerage account, you don't know what the purpose of that money is. You know, you don't know if that's their plan A retirement money, or if this is just a little bit of fun money for gambling. And even if it is fun money for gambling, I had an account when I was at Merrill Lynch. The guy had this sub account with $80,000 worth of individual stocks in it. And I asked the guy, I looked at the stocks, there was no portfolio structure to it. The stocks didn't make any sense. I said, what's going on with the sub account? You've got 80,000 bucks worth of stuff in here and it doesn't make any sense. He says, oh, those are my losers. So his way of gambling is, instead of betting on football games, he would put, you know, 500 bucks on an IPO. And if he was right and it went up, he would sell it and take his profits and be happy. And if it went down, because of a psychological bias, it's too painful to realize those losses, he would just leave it alone. But over time, a lot of those businesses are good businesses and will have good returns over the long run. So his losers from gambling grew to be 80,000 bucks. And you could look at that account and say it underperformed the market, but it sure as heck beat the pants off of all of your losses from sports gambling, because your losses in sports gambling are zero. So would you rather have zero or $80,000? So having poor data, having data on small accounts, I don't think it's, you know, as certain as the academics would make you think, that the individual investor really does have to underperform all the time. But there definitely are people who should not trade. There was a really hilarious reality TV show that took place during the global financial crisis, only like 4 episodes. It took place in England. I forget the name of it. I think it's $1 Million Traders or something like that. And they take these random people from Britain, there's 8 of them, and have them manage a hedge fund trying to make these long short pairs. And there's one guy, he's manages his father's Quickie Mart, and he just has the worst instincts. He always does exactly the wrong thing, and there's just no talking to him, and he never changes. And there's definitely people like that out there who should not manage their own money. And, you know, it's like, I should probably never be a professional basketball player. I don't have any aptitude for it. No matter how hard I practice, I'd never be a professional. I just shouldn't go down that route. There's people out there like that, but I would be the consensus that, you know, index funds just beat everything and people shouldn't do it themselves. I think that might not be indicative of how the world really is. And also, index funds look really smart on this 20-year up cycle. But now that we've reached the point that half of all money is passive, and that means Larry Fink just controls all the boards. One of the things I look for sometimes is, does the founder still own enough stock that Larry Fink, who ties CEO compensation to diversity, equity, inclusion, does Larry Fink just not control everything? And so one of the companies that I really like, it's an oil field services company that does, they don't do the drilling equipment, they do the pump trucks for fracking. And it's called ProFrac Holdings, and their ticker symbol is ACDC. Well, the father and the uncle of the CEO and the president, it's 2 brothers whose children are 2 cousins, and the older generation owns 70% of the company, and the younger generation manages the company. Well, it doesn't matter what Larry Fink's opinion is, he'll never get enough votes. That company is controlled by capitalists and not by bureaucrats. So the amount of voting control that Larry Fink has over the whole economy, and then what he wants those companies to do, whether, you know, he spends years telling everybody to do ESG nonsense or diversity, I think there is going to be opportunities to, you know, kind of short index funding and find companies that are going to outperform. Now, that being said, ever since I wrote about ProFrac Holding, the stock price only goes down. But I think in the long run, it's a fantastic one.
Excellent, excellent. So one of the things that impressed me, and you reached out to me directly, but I had been following your Substack for a while, and I was just really super impressed with the volume of work. I knew you did state you were unemployed, so maybe you didn't have anything else to do, but you really, I mean, just about every day you have a discussion, and they're not like, not well researched, they're very well researched, thought out arguments for particular, companies, and I want to caveat this before we get into this part of the program about any particular company we talk about, stock symbol, whatever. This is not investment advice. Obviously, we're not financial advisors. We cannot know your situation. This is for informational purposes only. So I want to caveat that and give that disclaimer. But can you talk about, what you're doing right now, what your thought process is, what your research process is, how you come up with ideas, and what you ultimately decide to publish an idea? What's that process?
Well, initially, I got in such a fast pace because it was easy for me to write about the companies that I had already owned and had been listening to on earnings calls for a couple of years. So I could write up an article about that relatively quickly. And I only have a portfolio of maybe 15 or 20 names, but after doing it, every weekday for a month, I was in that pace. And there are so many ideas out there. I've done some cross posting and use some other people's ideas and give them credit, but there is so much stuff out there that I can, usually I write after the kids are in bed, because when my 2-year-old and my 5-year-old are awake, there's really no sitting down and typing something out. So I'll usually, in the course of 4 or 5 hours, maybe from 11 to 3 in the morning, find an interesting company, listen to their last 2 or 3 earnings calls, dig into the inside ownership and inside transactions, kind of look at the structure of the market, and write a little summary and say, hey, this could be interesting. And I don't necessarily own a stake in all the positions. I only have 15 or 20, and I think I've written about 60. And some of this stuff has been on my watch list for a while, just kind of looking for an excuse to write about it. But it is a demanding schedule. But my wife was really understanding. We discussed it, and she's okay. We'll give it a year. And so far, just charging people $5 a month for my hot stock tips, it's already beaten the pay that I could have earned as an adjunct, because adjunct pay is just so terrible. And I think if I give it a year, it'll really grow into something pretty exciting. The source for ideas is it's kind of all over the place. Like I found Transocean because I had been listening to Jeff Gundlach so much that I was looking at debt. See, could I find some distressed debt with a high yield that I know is not going out of business? And at the time, the price of oil was $100 a barrel, and Transocean's debt was trading at distress levels. And I didn't really know anything about the offshore thesis. I said, hold on, how can oil be $100 a barrel and this company is going to go bankrupt? That can't be right. So I dug into it and I said, wow, the marginal cost of a new barrel of oil from shale is $65, and the marginal cost of a new barrel offshore is $45. Well, that's all you need to know. So I was able to just dig through that and buy Transocean. I think my first purchase was at $242 a share. And one of the accounting professors at my old university, he had been following this company for decades. He bought in at $1.05 a share. I mean, I think he bought 50,000 shares at $1.05 a share. And when it goes to 25, he'll probably be pretty happy with that. But I look at insider transactions, insider buying. I look at distressed debt. I look at traditional things like price to book, price to sales, price to earnings. As a generalist, it's tough because every sector and every industry has their own metrics that matter. And every metric has their quirks, like book value, because it's based on the price you acquired the asset for. Like I would have never found the St. Joe company in Florida looking at book value because they bought that land in the 1930s. So this carried a book value of like $35 million. And it's 100,000 acres of, sort of near beachfront property in the panhandle of Florida. So every metric is different. You just got to keep looking at everything and just cast a really wide net, and you just find all this interesting stuff. And and there's so many other people out there looking and talking about stuff. So sometimes I'll even write about a hot name on Twitter, and I'll disclose, like, this was not my idea. This is just what everybody's talking about right now, and here's my take on it. And so I just, I wrote about Braskem, the chemical company in Brazil. I said, look, I'm not buying this one, but there's a lot of people talking about it, and here's what it looks like and what's going on. It's a really fun. I love being a generalist investor because I'll never get bored. There's always something new to learn. There was a company across my insider buying screens, and I looked at this company for, there had been insider buys going on for years, and the name kept popping up, and there's more insider buying, more insider buying, more insider buying. And it was, Orion engineered carbon. They make carbon black that goes into tires. And on the earnings call, they said, hey, the United States is moving forward with tariffs or with anti-dumping protections against foreign tires. And I said, holy crap, well, Goodyear tire has been on my, value screens for a long time because it's trading at, dirt cheap prices. And they've got 20 billion in revenue, and it's at a market cap of like $2 billion, maybe $2.5 billion. And now I find out through this other earnings call that there's going to be tariffs against tires coming in from Thailand. So it's every company I dive into, I learn something new. And I was a college professor, but I always liked learning more than I like teaching. And so this is a world where the marketplace is so open-ended. There's always something new to learn. It'll never be boring, no matter how much I do this. So it's a pretty exciting little universe to stomp around in.
Yeah, I find that when I'm talking to people that are doing this, something similar, it's like the people that seem to be the most successful, or they have the most interesting ideas. I mean, they're just voracious consumers of information. And I think it's really, everybody's going to have their ability. I think that one of the things I was discussing with someone about this recently was, a guy I posted a talk. What was the guy's? I forget the guy's name, but he ran a hedge fund back in the several years ago. He no longer runs it, but he was giving a speech to a class of Harvard MBAs that were getting ready to graduate, and he said, I think the title of I posted it on my weekly thing that I put out, and he said the title of the discussion was, "So you want to be the next Warren Buffett?" And then it was like, a little bit of couple periods, and it said, "You better be a good writer." And so he was talking about that even in this room of, Harvard MBAs, for the most part, very intelligent people, very highly educated, that the chances of any one of them actually getting the same returns over the long term is very highly unlikely. And one of the things that I have become more fascinated with is it's not necessarily, am I a good researcher? Can I find these ideas? Do I have certain good screens, my process? A lot of it comes down to psychology and kind of like your emotional ability. And one of the arguments that was made in this article was, or his discussion was, this is kind of embedded into you, like when you're around 12, 13, or 14. If you go back and look at a guy like Buffett, I mean, I had something similar experience. I'm not putting myself with Buffett, but I can see what he was talking about. Buffett was starting businesses when he was like 12 years old and stuff like this. And you kind of see these people that were doing something similar or started investing when they were teenagers. They kind of seemed to have this, you kind of develop your mental model. And, one of the main things is, the ability to look at, like when we recently had this market correction, major market corrections, or you have a situation like, I'll give you an example where people fall down, I think. Intellectually, separating the intellectual from the psychology and the emotional part of this, which is what I think is really important, which really gets you from like, mediocre returns or slight to really, really above average consistently. When oil during the pandemic dislocation that the government caused by shutting the economy down, we had that oil headline when, oil went negative 47 or whatever it was. That was like, that's when you should be in there really buying all of these oil companies. I mean, if you rationally and logically looked at it, you say, yes, this is painful, and I'm going to have to overcome my chimpanzee brain that wants to survive and run away from, a problem or conflict. This is really ugly looking, the headlines, everybody's panicking. But that was the time where, you could have bought like a company. I talked about this before. Traded, I was just buying things in there for like less than $1. Athabasca Oil Sands, which is a highly levered company at the time, that basically was going to fail if the oil didn't go above 65 or $70 a barrel. Because of the debt they had. It was selling for like 10 cents a share. You could have bought all you wanted, but most people are going to run away from those type of situations. If you knew for a fact, there was stupid commentary in the mass media about this, is especially from this DEI really mentality, ESG mentality. This is our big opportunity. See, we can actually lower oil demand and we can, lower CO2. Well, this is ridiculous. The entire world is basically run on back of hydrocarbons currently. This is the way it is. So, if you noticed, for example, that oil demand basically dropped, even with the government shutting down the economies around the entire world, that oil demand only dropped from 100 million barrels a day roughly to 80 million. That should have clued you in that oil wasn't going away, because it has more uses than just transportation fuel. And so that was your opportunity. But the ability, yes, you can logically recognize that. You can write an article and make the argument to someone, but for them to actually commit to that, that's a fat pitch right down the plate. As Buffett talks about, you stand there with no balls and strikes. That's a fat pitch, and you have to swing, because that's how you're going to get those extraordinary returns. And obviously, that was a big. So the ability to do that. I mean, do you kind of getting into the esoteric here? I mean, how do you think like psychology and emotions? I think you either have it or you don't. Just like you mentioned earlier, you either have natural athletic ability that helps you be good at a sport. I can go out and go to the driving range and work on my short game. I can put all these hours in. I would become a better golfer, but I'm never going to be on the PGA Tour. It's just, for certain aspects that I have or characteristics that I have that are just not going to be sufficient. So I think it might be something similar to, and that doesn't mean you can't have a successful investing career. That doesn't mean you can't outperform passive investments. But I think there's a certain amount of that kind of is going to limit people from going to be extraordinary. Any thoughts on that?
Well, I mean, there's definitely different kinds of people in the world, but they also have different goals and different desires. So there's people who were a doctor or a dentist, and now they're in their 60s, and now they want that passive income. And as long as they can get over the volatility, they can find plenty of businesses with, a 9-10% dividend yield. And it's kind of in investing, you can kind of create a game where you can set yourself up to win. And I personally don't have the disposition to start researching a new company after the fire has already started and the barn is on fire. But if I have already researched the company and I start a very small position, because I did make that mistake early on of not position sizing properly in the beginning. But if I start a small position in a company I've already researched, and then the price crashes, and it crashes for reasons that I know are temporary, then I can dive in. So I don't think I would research a company that an explosion has just gone off. But if the research is already done, and I know it's a good company, and I know that the problems are all temporary, I have the conviction to buy more. So there's a company that I wrote about called Forward Air. They're a logistics company. And the guys at FreightWaves keep writing about this, but it looks like we're coming to the end of a destocking cycle. So we had the supply chain crisis from COVID, and there were 100 ships that couldn't unload at the port of Long Beach. Companies were saying, wow, just-in-time delivery is not smart. We should build up an inventory. And so that was a stocking cycle. And then manufacturing was booming. You had to fill up everybody's inventory. But then when interest rates went to 5%, they said, wow, this working capital has a huge opportunity cost, because now overnight money is 5%. And also the supply chain became unkinked. So we entered a destocking cycle. So for 2 years, businesses have been running down their inventory. Well, as they run down their inventory, it's terrible to be in logistics and trucking, because nobody's placing new orders, nobody's shipping anything. Well, the destocking cycle, it looks like that has come to an end, and just the transition from running down inventory to maintaining a flat inventory should be a boom time in logistics. So I was looking for a logistics company to start a small position in. I found Forward Air because of the insider buying. They were doing an acquisition. In this acquisition, the management team went about it entirely the wrong way. They had in their corporate charter that if it was going to cause a certain amount of dilution, they had to bring it to a shareholder vote. And professional management being, we talk about agency costs, principal agent problem in finance. Professional management doing what professional management does, they completely broke the spirit of the law. They did some clever dick solution about preferred shares that would have a penalty to convert. So they might have been within the letter of the law, but they crapped all over the spirit of the law and did an acquisition that caused a lot of dilution and never took the time to sell it to the shareholder and actually do their job as a CEO and convince everybody that it was a good idea. And I looked at this acquisition, and I think it actually was a good acquisition, but all the lawsuits that came out of the way of going about the acquisition, the stock price crashed from $110, I think the low was 12. And I had bought a small position at 70, and then I think I 4X'd my position at 19. And I think now the stock price is about 30, 31 today. Now, unfortunately, some activist investors are trying to convince management, hey, let's take this thing private. If the retail investor is not willing to stick with you guys and can't handle the ups and downs, let's take it private, and then we can keep all the ups, and then the retail investors get totally screwed. And that's a huge risk in small cap investing, is you find something good and undervalued, and then somebody takes it private for a 10% premium. It's just a constant threat, which is why I look for companies that sometimes I remember to do this, it has some reason to stay public. In the case, as a private company, you're only allowed to have a certain number of shareholders. So, for example, with Carvana, the CEO was giving personal stock gifts to all of his employees, and his number of employees was more than the number of shareholders you can have as a private company. And one of the big risks was that the low price, they could take the company private, because that's what his father had done, 30 years ago to his own company. The stock price is low, I'll take it private. So I was able to buy Carvana at $3.92 a share, pretty confident they wouldn't take it private, because you can't screw over all your employees and expect them to show up for work and work for the company again. So is a constant risk of companies going private. Anyway, Forward Air, I think the acquisition was fundamentally good. They just had their last earnings call. I thought there'd be a bigger reaction after this last earnings call, because it was the very first earnings call with a full 3 months of consolidated data. But the new CEO ripped off the Band-Aid and did a complete write-down of all of the goodwill of the acquisitions. You've got like $1 billion loss. So the goodwill write-down was $1.06 billion. But the net loss for the quarter was only $960 million. So if you look through the write-downs, they had $80 million of profit for a company that was trading in the dumpster. And then next quarter, without the write-down, it should, usually I'm very bad at identifying catalysts, but this one seems like a no-brainer that after the next earnings call, when you have a clean quarter with no write-downs, people are going to see, well, it was a good acquisition and these companies are fantastic if it doesn't go private before then. But yeah, I can't research a new stock after it's gone from 110 to 12. But if I have already done the work and I have a small nibble at 70, I have the fortitude to, massively increase my position size. If I know it's a good company, I know the price is really dirt cheap, I try and look for stocks that I think have a chance to double. And what usually happens is the stock price gets cut in half. And I say, well, if I put money in now here, it can 4X from here. But almost everything I find, I'm constantly amazed at how things can be so hated and the price can crash so much. That just happened. I chose the background with the shipping. It just happened to New Fortress Energy. So, and this is kind of a popular stock. I even got the idea from somebody else whose podcast I was invited to from the ROI channel. A great guy. He's had me on a few times. New Fortress Energy, in the whole shale oil space, you have extractors, you have oil field services, you have royalties, you have pipelines, you've got Warren Buffett buying liquefaction facilities, you have the shipping, you have regasification, and you have utilities. New Fortress Energy is trying to capture the whole space between liquefaction and the utilities. So they want to buy cheap US natural gas, liquefy it themselves, put it on their ships, bring it to Puerto Rico or Nicaragua or Jamaica or Brazil, build out the power capacity, and sell megawatt hours into the Brazilian power grid and capture the entire spread in between. I think that is a brilliant strategy, but it's taken them years to build out so much infrastructure. I think they're like $8 billion into building out this thing. And this last quarter, so that there's a lot of this stuff is just accounting quirks. Almost half the things I find, it's just strange enough. They had won a contract from FEMA to build 2 natural gas power plants in Puerto Rico to stabilize their grid. So So they had this huge fat FEMA contract. And a quirk of that FEMA contract is the Puerto Rican Power Authority had the right to buy those power plants whenever they wanted. They had this 2-year contract, and a year into it, Puerto Rico buys the power plants. And just the difference between their costs of building it, Puerto Rico's acquisition of it, they're contractually allowed to buy them at cheaper than it cost them to build them. But they still have this huge government contract that they won. And there's a government contract reconciliation process, which is pretty standard. As a generalist investor, you don't encounter it very often. So I start reading about it, and it seems to be pretty standard that they have this government contract. If they wanted to sue FEMA, they could probably get them for $1.5 billion for that extra year of delivering natural gas, which they agreed to do. So the reconciliation is FEMA is incentivized, rather than having to pay them $1.5 billion, they're going to pay them, who knows, $400, $500, $600 million for all of their costs, but it's a cost plus contract, so plus all the profits for the year they didn't operate. So, but you can't really book that in accounting. It's not a real receivable, and who knows when the government's going to reconcile this thing. But in the meantime, they won a 4-year contract to supply Puerto Rico with natural gas. And this is one of the most amazing things. I follow CEOs, and I look at insider behavior and insider buying. This is one of the shrewdest business things I've ever seen. If you look at somebody like Peabody Energy, in their investor presentation, they say, okay, in the Powder River Basin, we can deliver coal at a cost to us of $11 a ton. Okay, but now your power companies know what your costs are. They know what they can pay for it. New Fortress Energy is really tight-lipped with what it costs them to deliver stuff. And you don't know the money they're making from Jamaica or Nicaragua. You just really, as an investor, you have no idea how the sausage is getting made. But that allowed this guy to go to Puerto Rico. And I was shocked to find this out. 60% of Puerto Rico's electricity is from burning diesel, which is some of the most precious hydrocarbons, some of the most high-value hydrocarbons, because it's stable, it's really high density, and they're burning it for electricity. And so the CEO of New Fortress Energy gets to go to Puerto Rico and says, I'll lower your costs by 25%. And they agreed to a 4-year contract to lower their electricity costs by 25%. So this guy gets to buy natural gas for $2 an MMBTU. It takes about 7.5 gallons of diesel to make an MMBTU. And diesel is what, like $3.50 a gallon. So he's going to take $3.50 a gallon and multiply it by 7.5, and then subtract 25%. He's now selling the most expensive natural gas on the planet for a 4-year contract. I mean, this is some of the most amazing negotiating I've ever seen. And he was only able to do it because in his slideshow presentations, he doesn't tell everybody what his costs are. But in the transition from the FEMA contract to selling it to Puerto Rico, well, they have 3 months to pay. So you have a quarter where there was no income, and everybody just shat the bed and sold, hit the sell button, stock price crashed. They went from EBITDA of 325 in one quarter, 325 million, to EBITDA of 100 million. And they're guiding to EBITDA of 275 million next quarter. And those power plants, they were still operational. Natural gas was still being delivered. The only difference is Puerto Rico has 3 months to pay. That's the only difference. And this guy, if you take 175 million per quarter, and that's EBITDA, and multiply it out by 16 quarters for that 4 years of contract, that one negotiating tactic with Puerto Rico has more profits in the next 4 years than the entire market cap of the company at this price. Not including what they've got going on in Jamaica, not including what they've got going on in Nicaragua, not including what they've got going on in Brazil and their liquefaction terminals. I mean, the thing is just so cheap. And I thought, when I wrote about the article, the stock price was 25 and now it's 12. And so then I always have a couple of readers like, I followed you, I lost money, this is garbage. So I had to kind of remind everybody, I'm looking at stuff for maybe 2 years. If I have a 2-year time horizon, maybe I can beat the people that are smarter than me, that are doing things by the quarter, but also focus on the technicals and know how things are going to move in the technicals. So but at $12 a share, $13 a share, I just pounding the table on New Fortress Energy. And it's amazing to see a CEO who's able to be that shrewd of a negotiator to go to Puerto Rico and say, you're running electricity on diesel, let's sign a big fat contract. I will save you 25%. And then to be able to sell the most expensive natural gas on the planet is just fantastic. But in the earnings presentations, they're very tight-lipped about, where all their profits are coming from and what their costs are. Because if you're like Peabody Energy and you tell the whole world in the Powder River Basin, we can deliver a ton of coal at a cost of $11.50 a ton, well, you're never going to make any money in the Powder River Basin. So background today with the New Fortress Energy.
Would you say that that's your highest conviction idea right now? I mean, I want to
Oh,
segue into like two or three of
that's
your highest conviction ideas. Go ahead, sorry.
this is a really solid one. And I sometimes there are real unknowns out there. Like the price of natural gas is called widow maker for a reason. And I suspect as they build, I think the shale guys can just keep on drilling because of the byproduct natural gas, because they want the oil. And especially with innovation in shale, you've got some companies doing horseshoe wells, lowering cost per barrel of oil by $10 a gallon. I think we can just keep on making natural gas forever. But I could be wrong. Natural gas is a widowmaker. So if I'm wrong about that, it if there's a world where I can't know the future, I'd like to hedge it. So it's I don't know if New Fortress Energy is my highest conviction play, although they do use derivative hedging out for the length of the contract. So they're very well protected on this stuff. But New Fortress Energy is very strong. But I would love to pair that with somebody like Blackstone Minerals, which is a royalty. It's a royalty limited partnership that owns acreage in the Permian and in the Haynesville. Because if natural gas prices do go up, Blackstone Minerals is going to make just obscene amounts of natural gas prices don't go up. They still have a lot of Permian acreage too to get some royalties from. So stay cheap, you make money. If natural gas prices go up, you make money. We'll do. It's a fantastic way to handle the risk there.
Okay. Yeah, so if we I want to kind of open it up to like what a couple of names that you would like to talk about that, you're pretty excited about. Obviously we can't go over all. I mean, encourage people to go to your Substack and read through. But what are some of the like in the time remaining, like what are the like a couple of names that you're pretty excited about that really you're like looking at and saying, wow, this is really something.
Yeah, so let me do a little bit of self-promotion and try and encourage people to see what they get for $5 a month. Some of the stuff that I find is really in the accounting nitty-gritty. There's a company called Douglas Elliman. They're a realtor, and they're a realtor in the high-end space. So their average house sale is $1.8 million. There are realtors that their average house sale is $600,000. And in the accounting nitty-gritty, so with rising interest rates, the existing home market has completely crashed and is dead, and who knows when it'll recover. But what they did is when confronted with this dead market, they pivoted into new development condo sales. And they have a backlog. They have sold new build condos, 26 billion worth of them. Now, there's this really strange accounting quirk. So when Starbucks sells a gift card, it gets logged as deferred revenue, and it's a liability. So Starbucks might get $50 to deliver the cup of coffee. Well, because it gets booked as a liability until the condo's delivered. But the difference between them and Starbucks is Starbucks has to make the coffee. Douglas Elliman doesn't incur any cost to finish the condo because they're just the realtor. So you have tens of millions of dollars in the liability column of this company that really shouldn't be a liability. This is money that they've received, and they have no obligation to deliver the condo unit themselves. And on top of that, the way condo development sales work is you usually get half the commission when they get a down payment, and you get the other half the commission when the unit's delivered. And it takes about 4 or 5 years to build out these luxury condominiums. So they've got a backlog of 26 billion of high-end luxury condo sales, which has put to 60, 70 million dollars on the liability side of their balance sheet, which aren't real liabilities. And on top of that, I tried to reach out to investor relations. They're going to receive exactly as much when the units are delivered. So you've got $70 million, give or take, in the liability side, which shouldn't be liabilities, And you've got another $70 million coming in from the second half when the condos are delivered from the last 5 years of development condo sales. And this company was trading at $1 a share. It was a Benjamin Graham net. They had more cash on the balance sheet than their entire market cap. And on top of that, their liabilities weren't real liabilities. So digging into that kind of accounting nitty gritty, that's what people get for $5 a month on my Substack. And I've only found 5 or 6 or maybe 7 things that I put behind a paywall. But they're all stuff where, you know, nobody's talking about it. I can dig in, I can find something pretty incredible. And that's really fun. Most of the stuff I give away for free because I want people to find me. And even when I'm giving stuff for free, some people will just subscribe anyway, just to support the channel. But the stuff that I put behind the paywall, like this Douglas Elliman Realtor, is almost always something in the accounting that everybody is looking past. And maybe because I'm just such a nerd and I just keep on digging down and find this stuff. It's just an amazing. I think it's going to go to $10 a share. When I found it, it was $1 a share. Now it's $2 a share. So that's still probably a 5-bagger. And there's also some stink on it because they had $90 million in cash and they raised $50 million with the convertible bond issuance. It was like, what are these idiots doing? Why would you dilute raising a convertible bond when you have $90 million in cash? Well, the people they raised the money from, they are activist investors who finance real estate development. And they kind of gave some more insight on this in the last earnings call. Sometimes you have to strategically let a potential partner own a piece of your equity. This is how Shark Tank works, right? You have some product and you sell a 30-year company to Lori Greiner, and then she puts it on QVC, and that's responsible for a huge spike in sales. Well, the people that they sold this convertible bond to finances new build developments. So in a world where existing home sales are still slow and they're pivoting to new build developments, now that the guys that finance all these new build developments are going to be like, hey, here's an introduction to the real estate brokers we really like. Let these guys sell your new build development. So I think it was a really smart strategic decision. But again, it's just something that the market saw and didn't like it.
What's the symbol on that?
I think there was a really reason why they did that. They didn't Douglas Elliman.
Okay. Yeah, we're getting a little bit of a lag here, so something happened, but we'll try to continue. I mean, are you still hearing me pretty good? Hello? So Steve, are you there? Are you there?
Yep, I'm here, but I think my internet connection is terrible. I got to call Spectrum.
Oh yeah, I mean, you were lagging there for a while, but it seems like you're back. So this is short. I'll try to edit it out. Although I'm not the best editor. But anyways, yeah, let's try to finish up. We've been going about an hour. I wanted to ask you, just as a closing question that I like to ask people with my new final question. That seems to be the new thing everybody's doing. What's something that you're looking at, or an idea or whatever, can be a company or a thesis or whatever, that a lot of people aren't looking at, but they should be looking at? Might need to think about that for a second, but that's kind of something I've been asking folks. What's something that's out there that you're looking at that you find interesting that not a lot of people, I mean, obviously you just mentioned one, no one's probably even heard of it. I never heard of this company until you mentioned it, but something else that's out there that you're looking at and saying, gee, nobody's really talking about this?
Well, so I think we're headed towards sustained inflation. I mean, it's going to come and go in waves, and maybe they're going to, do a victory lap and say that they beat inflation. But I think there's going to be a sustained inflation for a while. I'm probably not alone in that. But I think there's a consensus that because in the 1970s inflation was bad for the stock market, that inflation is going to be bad for stocks this time. I think that's completely wrong. I had a this because prices were going up so fast. He wasn't marking his inventory when he sold it. By the time he sold out of something slow moving, he couldn't afford to replace it. And that's what the atmosphere was like in the 1970s. And that's why inflation was so bad for business. But that was before Microsoft Excel. That was before spreadsheets. That was before supply chain management professionals. Any company of any reasonable size has a supply chain management professional and Microsoft Excel. And as their costs go up, they're going to put that pricing in straight through to the customer. So I think inflation is going to be really good for equities generally. I don't think we have to have 18 years of depressed stock prices like they were in the 1970s. I don't think that's necessary at all. I think so. Even though I write about, gold, oil, and land on how to protect yourself from inflation, I think equities generally can do fantastic during this time because this time we have Microsoft Excel and it's just a totally different world and people can push these prices through. And I'm a bit of a econ nerd, History of Economic Thought. One of my favorite writers is Frederic Bastiat. And I was even going through there. He was arguing in the 1800s that inflation was good for big businesses because they can figure out what's going on and small businesses can't. So I think that this time you're going to see just equities generally do fantastic because not only does the stuff that they sell for more, but all the debt that they have gets evaporated in real terms. And I see so many people saying, oh, I want a clean balance sheet. I want a clean balance sheet where we delevered. Look at our clean balance sheet. I want this debt to get totally evaporated and destroyed. Warren Buffett wrote a thing in 1977 about how inflation swindles the equity investor. And part of it is because when you go to rebuild these things, you got to pay so much more for it. But if you have debt and that debt gets destroyed in real terms, you have to pay interest in the meantime. But I think having some really nice long-term debt at low interest rates locked in is fantastic. So I'm looking for dirty balance sheets. Obviously, that companies have the income to be able to afford it. So for people that think that the stock market is going to go through a 10, 15-year bear market like in the 70s, I don't think it has to be that way. People that are looking for clean balance sheets, give me the dirty balance sheets. Give me people whose debt is going to... my wife and I, we bought our house in 2019. At the time, we paid $240,000 for it. Zillow says now it's worth $430,000, which in real terms probably is not any more cheeseburgers because the price of everything has doubled. But our mortgage didn't double. Now we owe $190,000 on a $430,000 house. Jerome Powell gave my wife, she's only 32. My wife now owns 60% of her house. Jerome Powell gave that to her. If there was no inflation and we had just been paying our mortgage, she would own 7% of her house. Now she owns 60% of her house. That is a massive beneficiary of inflation. And if we do have sustained inflation, I want dirty balance sheets, and I don't think the stock market has to go down. So I write about gold, oil, and land stocks because that did outperform in the 70s. And if I had to pick one that might not outperform, because I do believe in a commodity super cycle, but I'm starting to suspect that energy might not be one of the big... I mean, the stocks are cheap, but they're cheap because of ESG, because nobody's allowed to own them and they're trading at a price to earnings ratio of 2 or 3. But the idea behind a commodity supercycle thesis is because people didn't invest in the sector, then there's going to be a restriction in supply. But with the shale oil boom, people have overinvested in the sector. So there's no commodity supercycle thesis in natural gas and oil because we've invested, to the nines in the Permian Basin. So maybe the commodity supercycle is going to be much more pronounced in the metals than it's going to be in energy this time, because energy is substitutable. You can switch from natural gas to coal. I write a lot about the gold, oil, land, inflation, and protection strategy, but I have a suspicion that energy might not be the best thing. Equities generally might do all right, and gold might do really... Land is going to do really well with increasing population density from all this immigration, but then gold is going to do really well from the BRICS trying to subvert the US dollar. So I'd say... that's kind of the areas where I'm looking at and where I'm thinking. And maybe in my most contrarian thing, I was looking at tech stocks recently, the small cap tech stocks, the Cathie Wood stocks. And some of these businesses were not pandemic only businesses. Some of them have improved in the last few years, and they can't catch a bid. These things are just so depressed and so destroyed. They're so bombed out. And once people realize that they're not a pandemic only business, I haven't done the digging. So maybe one of the next articles I'm going to write might be on something like Teladoc. Teladoc is not a pandemic only business, right? Because customer service crashed during the pandemic, you go to the doctor for an appointment and the administrative staff treats you like garbage. Like, oh, why are you coming here to bother us? You go to the doctor, you have a bad experience when you could just do a 10-minute Zoom call and get a prescription. You know, if you don't have a doctor that actually has to physically look at you, and also they're charging it to your employer anyway, right? You get it through work and then you pay $5 for your Teladoc call. So I don't think Teladoc is a pandemic only business. Their business is improving under the surface. And once things like that finally start catching a bid and people realize it's a tech stock again, they could go off to the races. So maybe my most contrarian thing is I'm going to go sifting through the Cathie Wood graveyard of bombed out tech stocks, because I think there's some treasure in there. So I haven't written about any of these yet, but that's probably my next area of doing a big deep dive.
It's interesting that you say that, because a big hero of mine, he's kind of really not that well known, is a guy named Dave Iben that runs Coppernick in Tampa, Florida. It's a kind of a contrarian outfit. And they're having a super terrific happy hour with Grant Williams and Stephanie Pomboy and these people down in Florida, I think in November. And they're inviting Cathie Wood. I think that's exactly the thought process that Dave Iben has also, that sifting through this, the tailings, if you will, of the previous tech, there might be some leftover gems there. So I think that's an interesting idea, actually. I wanted to ask you one more thing. Obviously, most people want the ideas. You've been very generous with your ideas here. I hope we can have you back. Maybe once you get your deal with Spectrum dealt with. We seem to be back now. But as a finance professor, I think you said you were dealing with undergraduates.
Yep.
One of the things I'm curious about is, and I'm going to, if you don't want to go here, just say, hey, I'm not really interested in talking about that. But, and obviously you have a background in economics, so you'll have a view on this. And you did mention what your views were to me before we started. We have this really, I'm really concerned going forward about this attractiveness that a lot of people seem to have towards basically overt Marxism. I mean, the especially among the young, because of, I think, this failure for our society to provide upward mobility, this big, huge gap between the haves and have-nots, the concentration of wealth we've seen before historically, what that can lead to. And then you see these policy prescriptions that somebody wrote for this Democratic candidate. I mean, she doesn't know anything, but basically price controls. I mean, basically, just basically massive interference, basically like just basically right out of the Marxist playbook, right out of what you would see in Gauss' plan in the Soviet Union. I mean, is this really that attractive among a certain amount of population, or is it just a reflection of, hey, my life's not going the way I want? Or, I mean, I don't think people even understand these concepts. I mean, supply and demand, they're just not educated on these things. They don't know history, but there seems to be this attractiveness towards socialism and now this overt Marxism. I mean, there's a certain amount of the population. I mean, a lot of this stuff is based on emotion, I know, and rhetoric, and that's a different subject. But I mean, you've dealt with a lot of young people. If you were teaching undergrads, what's really going on from your observation? Obviously, you have a limited data set for just the people that you are looking at. It'll be anecdotal, but any thoughts on that?
I had a pretty charmed experience because I only dealt with declared business majors. And I think in the College of Liberal Arts and Department of Education, Department of Journalism, yeah, you've got a bunch of, jackbooted Marxists trying to take over the world. But in the College of Business, I found a lot of really amazing young people that are going to go out there and do amazing things. And it really reminded me of that old Tytler cycle, the Alexander Fraser Tytler cycle, about how, hard times make hard men, and hard men make good times, and good times make soft men, and soft men make hard times. I see a lot of young people, college business majors, that are really hard men and are going to roll up their sleeves and do the work. And I think they're going to make some better times. Now, they might be totally outvoted by the education majors and the journalism majors. When the College of Business, I could not be more enthusiastic about the future. The young people I taught were absolutely amazing. And when I would ask them questions, how many of you in the class ever censored your opinion because you were afraid of retaliation from the instructor? The number of hands that were raised would just make you cry. I mean, I was just shocked at how far academia has fallen, that people are not interested in trying to build up young people so that they're strong and can make up their own minds, but they're just trying to, proselytize and try and it's just really heartbreaking at the total destruction of academia in this country. So I am bearish academia, but I'm bullish young College of Business graduates. I think they're amazing. I think they're fantastic. Another thing that's going on is a lot of people that are looking at, the fall of the Roman Empire and parallels to today. One of the big changes that happened in Rome is when the small farmer was, communalized, and all these people became laborers. And you take essentially small business people, entrepreneurs, and you turn them all into employees, and that was correlated with the fall of Rome. When you look at the gig economy today, and what percentage of the population now that would have been employees in the past think of themselves in their own mind as entrepreneurs, I think this is a massive shift, just this enormous tidal wave of people that before would have a crummy dead-end job, and now they're driving Uber, and they're walking dogs, and they're doing Grubhub deliveries, but in their mind, they're entrepreneurs. They're small business people. And as soon as they have some capital saved up, I look out for them because they're going to open a franchise, they're going to do the next thing. So the percentage of the population that is an entrepreneur is growing for the first time. And I think there's really a chance that the future could be brighter than any of us could ever imagine. But there's also this horrible academia trying to convert everybody to Marxism. And they go out there and they're very effective at what they do. They seize power, they destroy everything they touch. It's definitely miserable. That does exist, and it is there. But to have this undercurrent, to have these young people that, the global financial crisis hit when they're in elementary school. These young people are tough as nails, and they're ready to go out there and kick some ass and take some names. There are some with social anxiety. There are some with all sorts of other problems, but I am really impressed by young College of Business graduates.
Okay, excellent. So we've went over about an hour. It's been tremendous. I really appreciate it. We did have a little bit of technical, but that's fine. Is there anything else that we should cover or that you wanted to talk about that I didn't? Well, we didn't really have a scripted interview here. We kind of jumped all over the place. But any closing thoughts? Why don't we, why don't you tell the folks listening where they can find your work, and I'll post your Twitter feed, your Substack in the show notes so people can find you if they're not already familiar with you.
Yep, I'm on Substack at the Unemployed Value Degen. I think at some point I was trying to call it Unemployed Small Cap Value Degen, but the name just got so long. So however it's written, I think it's Unemployed Value Degen. I've been writing every weekday, so 5 articles, and I did a poll, and my subscribers say it's too much, we can't read all that. And I do want to listen to them, but I also want to try and get my name out there as much as I can. So it's definitely a fire hose at the moment. But for my paid subscribers, I put out a model portfolio. So not everything I write about is something that would make it into a portfolio of 20 or 30 names. So I definitely have some sweet treats for people that are willing to pay me $5 a month. And I'm keeping the price low because I want to try and get my name out there as much as possible. I mean, I've got people paying me $5 a month from India, and there the GDP per capita is really, but they've got 1.4 billion people. So I don't mind keeping the price low if there's enough people out there that read in English. And it's such a global world, and I've got such amazing feedback that people really like what I'm doing. So it's so encouraging. And then, sometimes I write about something, the stock price gets cut in half the next day. But yeah, I don't have to talk about any more stuff. Maybe if there's a chance that I'll be invited back, I'd happily to leave the audience wanting more.
I think so. Like I said, you guys should check out Steve's uh, writings on Substack. Again, we'll put everything in the show notes. This has been tremendous. Thanks a lot, Steve. We appreciate it, and we'll definitely be having you back because you're definitely pretty good thinker. I like how you think. So tremendous. Thank you very much, and we'll talk soon. Thank you.
No, thank you for having me on. It was really a privilege and an honor.
All right. All right, guys, that's it for this one, and we'll talk to you next time.